Welcome, everyone. I'm Greg Schnell, the Canadian technician, here to host the Market Buzz. This show looks at weekly setups across the U.S. market. We'll look at tools available on StockCharts for long time frame trades. Please subscribe to my articles and Twitter feeds. So we're still wobbling. Market's pulling back a little bit. I have to show you some. I'm going to cheat and show you a picture. So this is where I was on the weekend golfing, 18th hole at Eagle Ranch, and that's about the best news I've got today. Everything else is pretty murky, so I just thought I'd share some good news today. I do have a couple of things I want to talk about. So I see red flags all over. Martin Pring sees bull flag showing up. So I want to talk a little bit about the difference between Martin's article, and for those who aren't members, you're missing out. You have the opportunity to get Martin Pring for whatever, 20 bucks a month or 30 bucks a month. That's just crazy value. So anyway, Martin's and John's article, John Murphy's articles show up for basic investors. Or basic memberships. I would just remind you how valuable that can be. If Martin's right, this trade is about to kick off, and his data suggests it's ready. My data suggests we have more work to do. But more yield data and other recessionary points. We're going to talk about those things now. We're going to get into the schedule here. This is I'm doing a bit of a road trip in September. So San Francisco at the Golden Gate University. And if you go to the tsaasf.org website, it's on the homepage, and I'll show you that page in just a second. And then the CMT Association meeting in Minneapolis, September 17th. I'll be there with Craig Johnson, Ralph Akampura. Should be a pretty good one. Toronto Money Show, September 2021. Obviously, most people are familiar with the money shows and the trader expos, but I'll be going to that one as well. So anyway, if you can catch me at any of those three, I'd like to say hello. First of all, let's get into the market and just make sure we're updated here on everything. Should be refreshed, but we'll just refresh it. So we quickly scooted down on the overnight trade, and I think it's probably Autodesk more than anything dragging the Nasdaq 100 down. It dropped pretty precipitously on slowdown in revenue expectations and earnings expectations for 2020, and I think it was more on the back of their announcement than on their earnings, but they thought it would be prudent to kind of warn. So anyway, this chart is down here in that bottom right here corner. Let me just show you that. So that was a bit of a drop below kind of 6 month support, and very, well, let's just say approaching this major support level down here at 120. So anyway, keep that on your list, but it was starting to wobble here. You can see the scooter ranking had been great and then started to weaken and then had this precipitous fall in late July, early August, and now continuing down below the 200-day moving average. So that doesn't look that bullish. But getting back into the members dashboard here, we're trying to hold this rally, and I want to show a couple of things for people. So you select which chart you want to look at, and I like the Russell small cap. Many people know that, but the reason I like it is because it's good for kind of seeing the small caps get weaker before the large caps. So watching this very intently, what we see here is this last three lows got broken this morning on the Russell, and now we just want to see if there's any sort of horsepower. So anybody who wanted to get really bearish on the open, this was their opportunity, and now they've been whipsawed. And the real question is, can momentum start to improve? And we could just see this downtrend in momentum here. This is a 10-minute chart. You know what? I could make my pointer bigger. There we go. So this is a 10-minute chart. But what I want to show you here is this momentum downtrend. If it got broken here, we could have some sort of a rally. And I think this is the daily chart going back. 2018 low is over here, but watching very closely at this 1450 level, and you can see we're testing it. in order for the PNF chart that I'm going to get to in a second to break down, it needs to get down to 1443, which would just be, 1/3 of this next box. So pretty close. And what we're watching for here, obviously, is the momentum weak enough to break down. And from Martin's work, he shows that his bottom fisher indicator is starting to go positive. So that's quite an interesting thought for me, because I don't see that yet. On the Russell, we have a 40-week moving average rolling over here. We have a 10-week moving average in brown. We're below both of them, but not very far. And again, this big drop here in December 2018 is worrisome, and the PPO rolling over below zero and continuing to go lower. All of my data suggests that this move down continues, but Martin's bottom fisher kicking in is quite important. So here's an uptrend line that held the big bull market off the 2016 lows, and it rallied up. And then you can see here in 2018, when it broke, it was a pretty important place to be aware of. And this is December. So B is November. It was rising, fell in November, rose back up in December, and then fell really hard in December and came all the way down and broke. And we're sitting right here at this blue trend line. So what happens when this blue trend line gets an O below it? It'll show a crack first. It'll just show that it's sitting on the line. And then when it does that, if the market actually breaks down and it starts to fall, then it'll draw these red trend lines automatically up on top based on the last high. So I think it would draw it back up here. And then, and the reason I say that is because you have an X here and then a higher X here. So it usually uses the last high off a rising market. And so it's coming down here. Now, when it gets here, once it indicates a red bear market, that doesn't mean anything more specific other than, you're in a danger zone. And what you can see is the red zone gets added back past when it was still in a bull market. So it just goes back to the last high. So the fact that there's an uptrend and a downtrend here, that doesn't really exist like over in our case. So it would start the red line here and come down. But as you can see, there's still a blue line in that area. It's only going to draw that red line when this blue line breaks. So we're looking to get to 1444 even, or 1443 would be what would make this line start to break down. And when that happens, then that would be an important place for us to just be aware that the small caps are giving up. One of the other things, just going back to the member page here. So this is the way I like to get to the gallery view, and you can customize all of your gallery view charts. And when you do that, again, what you do is you select your intraday gallery view, your daily gallery view. But if you look here, what we're watching, this is the Nasdaq 100, and the PPO is sitting right at zero here, and it looks like it wants to roll over. Again, this is a 10-minute chart. Let's not get too carried away. It's 2 weeks of work here. But if this is going to roll over, that's just quite weak. And so that's kind of what we're watching for, is which way is the momentum on this. And I think more importantly for the Nasdaq 100 is if this is going to crack this trend line, this is not a good place to initiate long. So I would watch very closely, and if Martin's right, and we're going to get to Martin's article after a break here, but the big thing for me is all of these charts are still painted red on the elder system. So red means can't touch it, especially on the weekly. When the weekly goes blue, you can start to look at it. And if you were going to do that, then you would go to the daily chart and the 60-minute chart to try and find your entries. Now you can see we were down here, red, and then we had a big blue candle, and the blue candle is caution and the green is full-blown market's fine. There's very simple rules for the elder system, but the point I want to make is we're riding this lower Bollinger Band right in here on the Nasdaq 100, and typically when we start to break through the bottom of that initiates more selling. So when you get outside the lower Bollinger Band, that's when I would worry. So today, the lower Bollinger Band is 8067. We're trading, 72.10, and we're trading at 75.56 currently. But the bottom of the bar is what we're watching for. So while this is going on, it might actually be down here. Yeah, it's a little bit lower. This flag is confusing. So, or this price label is confusing because it hides the edge. But what I want to watch for is if the Russell's or the Nasdaq 100 starts to break down below this lower boundary. I think that would be a pretty important piece of data. Now, as we're working through this market, again, one of the big things that I see is, I've got my Schnell Strength Index kind of going behind the scenes, and it continues to deteriorate. So I'm not getting any sort of refresh mode. When we talk about the market going up, we want to keep track of how much momentum there is, and I'm finding very little. So as an example, we're expecting some sort of monetary stimulus out of the EU, and this is the European financials. This is from 2016, 2018, and now we're breaking down below that low. The PPO is below zero here. There's not a whole bunch to get positive about, and I think it would be early to kind of say everything will work out fine. When the financials start to crack as they did in 2015, let me just open this chart up a little bit. When you get this crack, so what happened here, this was obviously a big uptrend, and whether you use this uptrend or this horizontal line, when it started to break down, this was a place to be pretty cautious, and we're kind of there right now. We're sitting on this line, and if it's all of a sudden going to start to crack, that would be a big deal. And you can see the volume last week was unbelievable on the European financials. So something's going to go on here. Now, I have a whole bunch of charts that we need to get to. This one I'm going to tease you. This is the 3-month minus the 30-year. So the shortest bond, or the shortest treasury, the 3-month treasury against the longest treasury. And right now the 3-month pays higher interest than the long one. So kind of a crazy time. We're going to take a quick break here, go to commercial, and when we come back, we're going to cover off a couple of other recessionary indicators that fired off in April, or look to fire off in August and September, and then we'll get into Martin's blog.
Missed the live show? Want to rewatch a workshop? Tune into the StockCharts TV YouTube channel to catch up on the latest programming and content. All of our live shows, workshops, special guests, and more can be found there. Each category has its own playlist, so it's easy to locate. We even have chart school and creative strategy videos to help you become a better technical trader. Leave comments for our commentators, like your favorite videos, and don't forget to subscribe to our YouTube channel.
Okay, we're back, and what I want to talk about now is one of the things you'll notice here is I've turned off the legends. And the reason I did that was just so that it would add a little bit of mystery. So you have all of these yield curve. In this case, it's the difference between the two yields. And you can see they peaked up here above this zero line. So the bottom blue line is zero. And when they peaked, that was a pretty good call in 1990. And this was the Japanese market. This was the US market, and it still dropped for 18 months or whatever. And the German market kind of held in and then fell, much like the US market, and then rallied from there. So that was a pretty big one. And you can see this came down here and started to rally out of the hole. And in 1995, lots of people expected a recession because there was some yield curve inversion. The 30 never got above, or the 3-month never got above the 30. And then in 2000, it clearly did. And in 2007, it clearly did. And here we are above zero. And again, the question is, are we going to get this first little hitch and then we have a big market rally? And maybe that's what Martin's work is pointing to. I have a few other charts that are just important to kind of consider. So here is the 3-month versus the 10-year, and I know everybody's working on the 2-year now, but you could just see these 5 spikes were pretty good indicators up to serious levels, and we're pretty much there now. So would I expect a reversal? Absolutely, because we're at this level that it rarely gets to. We're in, going back 1982 to 2020 basically, and here we are with only the 5th spike up to this 0.5 level. I think we probably had enough of that. So just be careful on that. That could change quite quickly. Here's one chart that we're going to get a little bit of information on coming out pretty soon, and this is the University of Michigan Consumer Sentiment. What you see here is a 65-week moving average rolling through the data, and for the most part, when you're above it, things are pretty bullish, and when you're below it, things are cautious. And you could see back in 2000, that was a meaningful trend change, but it did stay below all the way down here. But again, in 2007, we had the big drop kind of below prior support, and that was a better clue. Anyway, so it's not 100%, but it's not a bad place to pay attention to. And then we have housing starts, which is one of my first ones on this list. I think it's this one. And when I look at this chart, you can see it looks to me like it's rolling over. And again, we're using a 40 period moving average here, so 40 weeks. And what we're looking for is, as this rolls over, this is kind of important. And again, you can see that for the most part, it held up all the way through. In 2000, it dipped below. In 2006 and 7, it started to fall apart. Obviously, that was the big housing issue there. But back in 86, this was moving down meaningfully, and the recession started in 1990. I drew a line across here, mostly just to say it used to be up at that level. Now we're having trouble pretty much middle of the range, right? 0 to 2,500, and we're at 1,200. So there's some things to pay attention to, but momentum dropped below 0 briefly, and now we're still above it, but we're going to get some numbers on that coming up soon. Oh, I forgot to mention, so when I was talking about having those legends turned off on the other one, this is how you turn them on and off using the legends command. And the point I want to show is it just takes out, what is this curve, and then takes out the information that holds inside the box. And if you turn it to verbose, that will give you the long-winded explanation. So here is the housing starts, new privately owned houses, and then the PPO curve here you can see goes down, and we're at 0. And if I wanted my little zoom thumbnail on the end to get a close-up view of what's going on, it'll show me that it's falling away from its signal line. It's barely above 0, but it's still above 0. So anyway, we'll watch to see what happens this month, but that would be another indicator. So I want to contrast those pieces of data, so all of the recession stuff, and again, get that change in tone, and maybe we get this kick that Martin Pring is talking about. And so Martin said, when the crowd screams recession, technicians should prepare for a bull market. And this is an indicator that he likes to use called the Global Advanced Decline Line, and is just reversed from an oversold reading. Now, I will point out that, look at this oversold reading here in October of 2018, rallied up very briefly and then fell apart again. So it doesn't necessarily mean that we're going higher. It just means that we're ready for a relief rally. And sometimes it can be a very big bullish one. So in this case, this is 2016. This was the actual commodity low. This was the Federal Reserve low of October, end of October, November 2nd. And then we had the election, and then that was a big rally in there. And then since January 2018, you can see we've been living below the half level here, and the market hasn't done anything. So we've been down in the deep bottom area here. And again, watch these waves. Again, a rally wouldn't surprise me, but my data is pretty red. So I'll wait until I get something that gives me a little better clue. Now, in this case, he's got the New York Composite, and what he shows is his bottom Fisher indicator, which is this particular chart. And it's an indicator you can get on StockCharts. exclamation mark PRBFISH. And I think it only works on indexes if I'm correct. But I'd have to go back and check the data on that. Anyway, one of the things he gets is when when it's in this normal mode, everything's fine. There's nothing to worry about. Now he got this signal in here, and I wouldn't call that much of a bottom. It basically bounced for a day or two, and it missed this one. But it did a really good job of catching this one in interim in October. And this was a pretty major pullback, and then it shot up from there. And then we fell mostly in December, and that was, the chart kind of blurs it, but it was a December Fed meeting, December 13th, 14th, maybe the 17th. And all of a sudden things unwound into the December 26th low. So these are pretty big pullbacks. And then we're sitting here at support, and his indicator is trying to turn up. Now, doesn't mean it will turn up, but it's trying to turn up, and we got to wait to see how it's going to finish. But his point here is that price is at the same level, but the volatility index has dropped, and if it's going to keep going, that would be okay. So expecting the volatility to drop, and then things start to get bullish. And one of the things he points out here is these are kind of the defensive sectors. So let's scroll down to the offensive sectors. So the cyclicals, financials, industrials, healthcare, technology, and energy have all been declining. And, the real question, are they going to make another higher high? And Martin's thoughts are that they will. So I'm less bullish, and one of the reasons is when I go in and do my analysis by industry group, I'm getting different results. So I'll wait. I might be a week late, but I'll wait and get my data coming on. Now, I do want to point out a couple of other things that are going on. So I showed you the European financials. In my recessionary watch, one of the things that I like to keep track of, obviously the railroads I've talked about a little bit, but look at this railroad chart here for the last 7 weeks. This thing is screaming lower. And I think if global trade is going to be a problem, that's an issue. And you could just look at this chart. Here's 2006, we broke the trend. 2008, we broke the trend. 2011, we broke the trend. 2015, we broke the trend. And now we've broken the trend in 2019. There's meaningful jags not in every one of these, but in most of these. And if you go back and compare that with the S&P 500, they give you a pretty good idea of where the S&P had problems. Now, the 2006 gap in the railroads down was a very brief one, and it immediately started a correction. But my suggestion would be that when the railroads are starting to improve in relative strength, that's a good place to get on board. When they're declining, it's a much more cautious environment. In my opinion, we're declining in relative strength. So moving into the banking sector here, the one thing I'm watching for as we come up on the end of the month is this trend line is getting very important. Again, going back to the 2009 lows, and I'm pretty sure every Federal Reserve member has seen that chart. So if there was a place to expect them to step in, it's probably there. This last one is the industrial production. Just let me clear my throat for a second. This last one is industrial production. And what I want to point out on this particular chart, doesn't look like much, but if this starts to close down below this 40-week moving average, it's a good place to be cautious. And if we just unwind the tape, we'll see that, for the most part in 2000, we were falling below it. We rose above it. And this is just a simple 20-week moving average. And we stayed above it until 2007, early 2008, and fell below it. Stayed above it into 2015, fell below it. And here we are sitting above it, but we've turned down. So the data coming out over the next couple of weeks, this is still July 1st data. It comes out a little bit slow, but when we get the data, I'm interested to see if that doesn't, in fact, change the tone. Now, the other thing that you can see here is you can draw trend lines on the momentum. Here it was pretty much flat for a long period of time and started to break. Here we've got a big momentum trend, and we're coming into to test that. And to me, lots of my work finds that when these larger momentum trends break, that would be an important place on the chart. So I want to keep watching those. Again, that picture of golf I showed at the beginning was to try to lift everybody's spirits, but there's lots of cautious stuff that we need to look at. And again, the 30-year making new lows or new highs in price, new lows in yield. That's a pretty big deal. The 10 years obviously been stretched, but I showed those charts I showed where the yields get so far stretched one way and then start to move the other way. That is one reason for us to consider Martin's point of view as perhaps an inflection point. And then as the yields correct, the market pops to the upside kind of one last time, and then we roll back over. So that's definitely a possibility, but I still think the recession, all of the signals have come on. And so we want to be very aware of those signals starting to show up. So here's the semiconductor index, and I don't talk about this one very often, but the one thing that we see here is it's holding in relatively nicely considering all of the issues around technology and trade. I think that's a pretty important one. If I'm looking at my MACD, it's definitely going lower here, or the PPO is going lower. MACD histogram looks like it's about to break lower again. And what we find just in general, if it's going to go below zero, that would be a more important clue. Now, sometimes you have to wait quite a bit off the high to get to that point. What I want to watch for here is how does technology behave relative to the rest of the market? And I've shown on the weekend chart watchers, or sorry, not chart watchers, the weekend market review that I did this week. It was called the Wobbly Week. And in here, I have the FANG index. And again, these charts are all just being tested. And what I want to watch on this chart is, can they hold these trend lines? So this is Amazon, and it's starting to leak below the 200-day moving average. In October, that was a pretty good clue that things weren't all great. June, it was one day down, and then the next day up. We've been down here for 3 or 4 days now, so we'll keep watching. Apple has had trouble breaking out. Here's Facebook, and it's stuck just under this trend line. Doesn't make it bad yet, right? One day isn't a trend. What we want to watch for is, does it close the week down here below that trend line? And that probably says something more is cracking. Here's Google, pushed down. It's having a nice day today, trying to get back up into the range. Netflix is still trending down. Microsoft, which has become the new darling under Nadella, just tested below this line and is moving back above. I'd say that one's a really important one if that one starts to break the uptrend line. I have it based on the last 3 data points, not on this one far down here. And the reason for that is just, if you got 3 or 4 data points, that seems more meaningful than to pick one extreme low from way back. Now, I could also draw another trend line in here with a little lower slope. You get the idea. We're trying to watch to see if all of these stocks are going to break down together. And they haven't yet, but it's pretty important. Here's Adobe, and it's sitting below the line. So we're starting to see some of them break down. My big thing to watch over the next couple of days, you get the jobs number next week. As these economic indicators come out, we'll find out if the market turns bearish on us. And once again, we're heading towards the end of the month, and it was kind of August 1st that everything broke. So with that, thanks for taking the time to join me on Market Buzz. Market Buzz airs live on Wednesdays and Fridays at 10:30 a.m. Eastern Time, 7:30 a.m. Pacific Time on StockCharts TV. You can also catch replays on the StockCharts YouTube channel or on StockCharts TV, which has a running list of technical charting informational shows. Thank you.